Welcome to Premium Cashflow Real Estate Investing Podcast with SK080. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK080, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK080.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of speaking with Michael Brady. Michael Brady is with Madison Exchange. He is a veteran lawyer and is just a seasoned investor who has done a ton of work within the 1031 exchange area. Michael is vice president of Madison 1031, a national qualified intermediary for tax-deferred exchanges, pursuant to IRS code 1031. As a certified exchange specialist and attorney, his responsibilities include consulting with clients and their advisors to provide guidance on regulations affecting the 1031 exchanges, as well as overseeing the Madison 1031 exchanges national sales and marketing efforts. He regularly gives seminars which have received rave reviews, which are absolutely entertaining and informative, and I have seen some replays of those as well. And he is also a advisor to law and accounting firms, as well as some brokerage companies nationwide. Michael, of course, has published a lot of articles on tax and legal issues, and absolutely an authority on the 1031 exchange, and a very reputed author on his blog as well. So unbelievable resume, Michael. You bring in a lot of experience. Give us, in your own words, a quick review and a background of how you got into, sort of the 1031 area, and how you have helped clients so far. And we'll get into the subject of the discussion today.
Sure. First of all, SK080, thanks for having me on. This is great. I appreciate it. And when you talk and you went through my bio and you said experience, I think experience actually kind of means old at this point. I still think of myself as a young man, but I've been practicing law since 1994, so it's been quite a while. One of the first, just how I got started in 1031 exchanges, I was a young associate at a law firm. I'm based down Long Island, New York. And the partner I worked for said, "Mike, we got this great project we want you to work on." And I said, "Great, what is it?" He said, "It's a 1031 exchange." And I was green. I looked at him and I said, "Well, what's that?" And he said, "I don't know. It has something to do with taxes and real estate, and go hit the books and figure it out."
Oh, boy.
Yeah. So this was 1994. So when he said hit the books, he meant hit the books, because we had computerized research, but this was kind of the beginning of the...
Back in the days, yep.
Yeah. So I actually had to go to the court library. I had to take out a tax treatise. I dusted it off, flipped it open to section 1031, and I read it. And then I read it again, and I read it a third time, and I realized I was in trouble. I didn't understand it. So what I ultimately discovered was I needed to find a good qualified intermediary to help myself and my client walk through the 1031 exchange. And that's exactly what we did. And that client was able to exchange a 5-family building in Jackson Heights in Queens, New York. And he bought a building lot out in the Hamptons on the east end of Long Island, which was probably a pretty good trade for him. So I handled a number of exchanges as an attorney for years for clients, and got involved in 2005 running the East Coast operations for a national qualified intermediary, where I did that for a number of years. And I've been to a couple of other companies, and then I joined Madison about 2 years ago to head up our national sales and marketing efforts.
Awesome. Thank you. Now, for layman terms, who like folks who may not have heard of, sort of the 1031 and alike kind exchange and things like that, that kind of the lingo gets thrown around. Give us some, just a basic definition of what it is, and, how can you maybe perhaps help clients and things like that?
Yeah. So the whole concept of a 1031 exchange, what we're trying to achieve is we're trying to defer paying taxes when we sell sell real estate. So when you sell any type of appreciated asset, you will pay taxes on the capital gain, the profit from that sale.
Sure.
Now, the rates, vary. So, the federal income tax rates are 15 to 20% typically, is sometimes in the 3.8% net investment income tax, depending on your tax bracket. If you have depreciation, the real estate portion, to the extent that you've depreciated the property, gets recaptured at 25%. If you have done a cost seg study, which you and I were just talking about, it can be higher.
Sure.
Because you've reclassified as personal property and you pay ordinary income tax rates on that, which can be in the 30s of 30% area. And then you have state and local income taxes. So where I live in New York, we have a state income tax that's almost 9%. Right? California is over 12%, I believe.
Wow.
City of New York charges a marginal rate of 3.648%. Right? So
Sure.
You're talking about taking 1/3 or more of your profit off the table when you sell property. Okay?
Right.
So,
right.
and so a
Absolutely.
I'm sorry. And a 1031 exchange allows you to defer paying those taxes as long as you reinvest in other property. Okay.
I see.
And the concept's based on the fact that if you had a property that I liked and I had a property that you liked and they were the same value and you and I traded deeds, well, that's a 1031 exchange, right?
Got it.
And the recognition is that why should we then have to reach into our pockets to pay the taxes? Because there's no money changing hands here. And
Sure.
so, this is something that's been in the tax code since the 1920s. The structure I just described doesn't happen that often. It's very rare that parties' interests align. And so they created a third-party structure whereby you're going to do a swap with a qualified intermediary.
Interesting. And describe that word intermediary as to, how that's important and why it exists, basically.
Yeah, so when I first heard the term qualified intermediary back in 1994, I thought, oh, this is great. I found somebody who knows what they're doing. They're qualified, right?
Right.
What I ultimately discovered, the company I worked with at that time in helping my client, they were very good. They were excellent. But I discovered that you do not have to have any special training to be a qualified intermediary. There's no test that you take to be a qualified intermediary. There's no school that you go to, no major in college that you take to be a qualified intermediary. You don't get a good housekeeping seal of approval from the IRS saying you are qualified. What it means is you are not disqualified. Okay?
I see.
A disqualified person cannot be that person's qualified intermediary. So any agent of the taxpayer is disqualified. Their attorney, their accountant, their relatives, any company they own a more than a 10% interest in, those are all parties that cannot be. But anybody else technically could be their qualified intermediary.
I see. So does I guess the company that's a qualified intermediary, do they need to have a licensed attorney on their sort of payroll? Is that what the technical requirement is?
Yeah, that's a great question. And so, we are an industry, quite frankly, that handles billions of dollars of investments for our clients every year. We're holding money on behalf of our clients, and we are largely an unregulated industry. Okay, so after the financial crisis of 2008, a handful of states enacted regulations. They were fairly modest. I think that maybe 5 or 6 states, basically governing where the money can be invested and bonding requirements, things like that. But it's a very, very modest, regulation. So it does make sense to do your homework because you do not have to be an attorney. Anybody can be a qualified intermediary as long as they're not disqualified for that specific taxpayer. And so you want to do your homework. You want to know that the qualified intermediary has some expertise in this area. So Madison, we have 3 attorneys on staff. Okay. We have accountants. We have 3 certified exchange specialists on staff. That's a designation that's given by our trade group, the Federation of Exchange Accommodators, where you take a proficiency test to show that you understand the regulations. And you actually have to be in the industry for 3 years before you take that test. You have to abide by a code of ethics. And we have 3 certified exchange specialists on staff. And you want to know what they do with the money, quite frankly, because in many states, there's no regulation. So you want to know that, they're not doing anything aggressive with the money. So we only put the money into escrow accounts. Okay. Typically we can set up a segregated escrow account that bears our name, Madison Exchange, but it has a sub account with our client's name and tax ID number on it, so it's specifically identified to our client.
Sure, for benefit of sort of things.
Right, exactly. And so you have that level, and then you want to make sure that obviously that's a company with some financial resources. I'm part of Madison 1031 is part of a larger group of companies called Madison Commercial Real Estate Services, which includes Madison Specs, which is our cost segregation company. The infamous Yona Weiss, who is the cost seg king, who we were talking about earlier.
Yes, absolutely. He was on the prior podcast as well.
Yeah, and Yona is fantastic, very, very knowledgeable on cost segregation studies. We have Madison Title, which is one of the largest independently owned title insurance agents in the country. And we have Madison 1031 and Real Pro Due Diligence, which Lease Pro Real Diligence, which does lease abstracting and financial due diligence on real estate projects. So we are a company of some resources. We're not going anywhere.
Right. That kind of puts it into perspective, the global umbrella around Madison, basically right there. Now, Michael, help us understand, or maybe give us a use case. Sometimes I like to say that, those are like the best ways that we can kind of go through and learn about this subject. And, it just makes it real. Give us a concrete use case of any one of your clients, how they may have used this, and that will kind of help us better understand this.
Yeah, sure. So our typical, it's not that uncommon a situation. Our kind of bread and butter is the client who is selling a piece of appreciated property. They've owned, let's say it's a multifamily that they've owned and rented for 10 years or so. Now, and this, of course, is pre-pandemic. We're filming this in the midst of the pandemic, but pre-pandemic, the market was very hot, right?
Absolutely.
And so, they were getting a premium for their property. And so maybe they wanted to diversify. So maybe they had a property that was worth $5 million, let's say. This is New York City property. This may not be everywhere. So let's say they had a $5 million multifamily property. Now they're in New York. Cap rates are somewhat compressed. New York is getting to be a little challenging. We have some things with rent control legislation that is a little challenging for landlords. And so they've decided now they want to diversify. So they want to sell and they want to go into other sectors. So they can sell this property in a 1031 exchange, take their $5 million, and they can go buy several proprities. And maybe and so maybe they decide, yes, they still want to have some exposure to the New York marketplace. So they're going to buy a 2-family house in Brooklyn Heights. Okay, actually, it's probably a bad example. Brooklyn Heights is way overpriced, but they're buying a 2-family house in Brooklyn Heights, $4 million. And they're going to take another $1 million and they're going to buy a Walgreens out in Minnesota. Okay. And they're going to buy something else. They're going to buy an Amazon. No, that's probably too expensive. They're going to buy, let's say, a distribution facility in Texas. Okay. And then maybe they have a little bit left over and they're going to buy something that's kind of passive. All these things are somewhat passive, but they'll buy something called a Delaware Statutory Trust, which is a type of investment property they can buy in a 1031 exchange. It's managed by somebody else. So now they've taken their $5 million. They've now bought a bunch of different properties which have different income streams, maybe in different sectors, so that if multifamily is hit, then they've got some industrial and distribution exposure.
That was something I was about to kind of ask you as well, Michael. Is that in your example, you're saying the person is going from multifamily to industrial to sort of logistics distribution of sorts, and all of that is allowed. When we say like-kind exchange, it isn't necessarily meant from, let's say, multifamily or industrial to industrial or multifamily to multifamily. It can be anything within the real estate arena. Is that correct?
Correct. You can sell a multifamily. You could go buy a working farm, right? You could sell a farm and you could go buy a factory. You can sell that factory. You can go buy an office building. You can sell an office building, and you could go buy 20 single-family residential rental properties.
I see.
All like kind of has to be real estate to real estate. So you cannot go take your 6-family house in Queens, and you cannot turn around and then go buy a yacht, right? That doesn't work. It has to be real estate for real estate. Only real estate may be exchanged in the 1031 exchange.
I see. And it has to be like the relinquishing property or the property that you're selling and the one that you're buying. It has to be a new purchase. It cannot be like any like, let's say if you own something existing, you cannot like use that sort of 1031 funds to renovate and things like that. It has to be a new purchase. Is that correct, Michael?
Correct. So you cannot fix up a property that you already own, nor can you pay down a mortgage. That's another common question. I own this other property. That's a $500,000 mortgage. I want to apply the proceeds. That does not work, unfortunately. It has to be a new purchase. There is something called an improvement exchange, where on a new purchase, you might be able to use some of the proceeds to make improvements to that property. That's a complex structure, though. But that's a possibility. But if you already own it, it's too late. You're not able to use it for repairs and renovations.
I see. Now help us understand some of the sort of the process related questions, like in terms of, when can I get this in motion? Or let's say if I'm thinking of selling and things like that, what sort of process wise or timing wise, what are some of the details involved in this?
Yeah. So the most important thing I could tell anybody listening today is that you need to set up the exchange before you close on any property. Okay. It's unfortunate that every now and then, I'd say maybe once a quarter or so, I'll get a phone call from somebody saying, I want to do a 1031 exchange. I say, great. When's the closing? And they'll say, well, it closed 2 weeks ago. And unfortunately, that's not an exchange. Once you receive the money, it's too late. You're not receiving a property for a property, right? So it's not an exchange. And they'll say, no, it's okay. Well, I didn't cash the check. And it doesn't matter. You received it, right? So if you received it, it's too late. So you want to get us involved before you go to closing at the latest. We like to have a week to 2 weeks notice. I recommend that you call us as early as possible, possibly even before you think about selling the property. Or as you're thinking about selling the property, because there may be issues that we can kind of uncover for you that you may not be aware of. Things like if you're in a partnership and you want to divide up, that's easier to do before you go to contract than after.
I see. Now, let me maybe ask a bit more sort of a hairy or a nerdy question here, Michael, is there a law, like when you're saying that, yes, you closed on it and things like that, you received the check, right? But legally, is it the requirement that the funds have to be, like, let's say if you're using a title company and during the closing itself on the HUD-1 and whatnot, does the title company has to kind of put that in writing that, yes, this is the, like, for example, Madison 1031 is the qualified intermediary that where the funds are going to be placed as an escrow agent. Is that the technicality behind all of this, that the funds have to be placed with the intermediary? Is that kind of what you're getting at?
Yeah, so there's a safe harbor that was created because, like I said, you and I described the swap between you and I, so that doesn't happen. So I should back up a little bit. So what actually happens in the usual 1031 exchange is they exchange with us as the qualified intermediary. So for tax purposes, they're going to give us their property. All right, so give it to Madison 1031. We're then going to sell it to a third party. We're going to take the proceeds from that sale. We're going to go buy a property from somebody else. And then we're going to give that property to our client in exchange for the one they gave us. Okay, that's what happens for tax purposes. But that would be a very messy transaction, right? We have two deeds on each side of the transaction. It would be very expensive because we'd have risk if we took title to the property, either property. And so it's enough that Treasury regulations permit direct deeding, which means that the seller and buyer on each side will deed the property directly, or a seller on each side deeds the property directly to the buyer. The only thing that needs to happen is the money needs to flow through us. So the seller is going to pay us. Now that means, typically what happens at the closing is you pay the title company, the title company takes possession of all the proceeds, and then they cut, they pay their expenses, and, transfer taxes, if there are transfer taxes, brokers, everything else, and the net will come to us.
I see. So, and all this is basically specified on HUD-1. Is that what you're saying?
Yeah. So best practice really is that the HUD-1, or, in a commercial, most, commercial properties, you're not going to have a HUD-1 or a CD. You're going to have some other type of closing statement that reflects similar to a HUD-1.
Sure.
They'll reflect us and as the seller of the relinquished property and the buyer of the replacement property. So it'll say, Madison Exchange as qualified intermediary for Joe Blow. Okay. And that's the only document. So the deed, everything else is done as you usually would do it. But on that, it shows that for tax purposes, we are the seller. Okay.
Mhm.
Our fee should be reflected there, and the payment to us of the net proceeds should be reflected there as well.
I see. Now, in that prior case, when we said that Joe has sold the property, now seller Joe is holding the check that came to the title that came from title company. He hasn't cashed it, but
Yeah.
his window of opportunity to pursue a 1031 exchange is gone. Is that kind of what you're getting at?
Yeah, once the benefits and burdens of ownership of the property transfer, if it
Hmm.
has not been set up in advance, it's too late. So
Hmm.
before you close, we have to be in the picture. The exchanger has to sign an exchange agreement with us, whereby he's agreeing that the proceeds will come to us. He has to assign the contract to us,
Hmm.
okay? The benefits of the contract, okay?
Hmm.
So that has to be done before he completes his closing. He can sign those documents at his closing, but 3 days later, it's too late.
I see. Now, again, another, sorry to kind of hone in
Yeah.
here, Michael, but let's say if someone has made a honest mistake and, is there anything that you can do to help them? Meaning, can they still come into a 1031 or is that window like completely extinguished?
There is the possibility that they can rescind the entire transaction. This is unlikely. I've
Oh,
probably
wow.
done this once.
Mhm.
So they'd have to do a total rescission, which would require the cooperation of their buyer. So essentially, hopefully the deed, you're in a state that doesn't have automatic recording. New York, it takes a couple of days to record a deed, right?
Right. Mhm.
In Texas, the deed is recorded same day. It's almost impossible. So essentially, title would have to go back to the seller. The money would have to go back to the buyer. If there's a payoff bank, that's not going to happen.
Yeah, that's too hairy right there.
Yeah.
I think
You'd have to
that's
cancel the
unlike.
contract. And the theory is you'd have to cancel the contract and
Mhm.
start at the beginning.
I
I've done
see.
it maybe once. I've seen it actually done. It was an all cash transaction. There was no payoff bank. We were in New York, so the deed wasn't recorded. We held everything up and they went back and they started all over. But otherwise, what I typically do in that situation is I tell them they cannot do a 1031 exchange. Maybe they want to look at something like a qualified opportunity zone, which is a little bit more generous in how you handle the transaction.
Right. Now, what about the sort of the replacement property? How does that come into the picture? Like, does seller have to pre-identify these things, or how does that work, Michael?
Yeah, so there are two important deadlines. So from the closing of the sale, the exchanger has 45 days to identify in writing their potential replacement properties. That would typically mean they would send us a list of properties. We try to make it pretty easy. You close on Monday. On Tuesday, you get a letter from Madison Exchange saying, "Dear taxpayer, we have your money, and here's a form to fill out. Send it back to us by 45 days from now." Okay. That means they give us a list of properties. Typically, they can identify up to 3 potential properties, regardless of the value, 4 or more, provided they do not exceed double the value of what they sold.
I
Okay.
see.
So they send us that list, and then they close on anytime after they close on their sale, they can close on their acquisition. They do have to close on something they've identified in those 45 days.
I see. Now, Michael, another question which probably, and you probably encounter this all the time, is that I give you a list of 3 properties and day 20th or 25th comes around and I change my mind. How does that work? Did I mess up the paperwork now, or am I still able to come back in within that 45 period and say that, oh, instead of ABC, I want to change 2 of these properties? How does that play into the picture?
Yeah, so I typically recommend that the clients do not fill out their identification and send it in until closer to the 45th day. Unless you're going to close on the property sooner, there's no reason to identify on day 20. Right. So keep your options open, have it ready to go. Day 43, send it in. If it's a holiday, send in day 40,
Sure.
Because these are calendar days. So, if your 45th day is Friday? Saturday is the 4th of July, right? So if your 45th day is the 4th of July, you got to send it in by the 4th of July.
I see. And also, Michael, like, let's say you said 3 properties, right? But let's say if someone is doing a large transaction and let's say there is a, $4 or $5 million capital gain here, right?
Yeah.
And if they want to perhaps go into like, let's say smaller, like a strip mall and a warehouse distribution center, as you pointed out, or perhaps the office building and things like that, meaning, more than 2-3 properties. How does that work? Like, meaning, are we still able to go into, like, let's say 5 or 6 properties?
Yeah, sure.
So like
it only
three
becomes an
is
issue.
the minimum, you're saying?
Well, three regardless of value. Okay. And the minimum is 1, right? So, you can identify up to 3 regardless of the value. It's a little bit of a silly rule, but if you exceed 3, the total value of everything you identify together cannot exceed double the sale price of your relinquished property. Okay. So if you sold for $5 million and you identify 5 properties, you cannot identify more than $10 million of property. Okay, but so it's really designed if you're going to buy a bunch of smaller properties. If you go out and you decide you're going to identify 6 properties and they're all going to be $5 million each because you're just going to buy one, that doesn't work. You would be limited to 3 in that case.
I see. And another sort of related twisted question, Michael, is that day 45 passes and you haven't yet, because, right now, as you know, the market is so hard that deals come in and sometimes you don't like them, which probably is the majority of the case. But what if you are just not able to identify the deals and you're really having a tough time? Is there any flexibility on that 45-day window? Like, are there any exclusions or anything for that?
Yeah, so we're so used to getting extensions and tax returns, right? You get that extension till September, sometimes October if you're and with COVID-19 we've had extensions, but typically the 1031 deadlines are hard fast. You do not get an extension. So you need to identify by 45 days. The other data I haven't gotten into yet is you need to close within 180 days of your closing. Those are hard fast deadlines. The only extensions that have been granted are when the taxpayer or somebody involved in the transaction or the property is involved in a federally declared natural disaster. Okay.
I see.
And then they've given extensions. With COVID-19, they gave some weird extensions. It's a whole different topic, but essentially that extension is about to come up on July 15th. So if you had a deadline between April 1st and July 15th, your deadline was extended to July 15th in recognition of COVID. So it was a weird kind of extension. It didn't really match what they had done in the past. We think there may be a basis to say you could be entitled to an additional extension, but again, that's a little bit of aggressive. And we have asked and are waiting, hopefully, for the IRS to give further guidance before July 15th. But otherwise, it's a hard, fast deadline.
I see. And then you're saying once you identify, you have to close within 180 days. And that 180 days, does that start from your prior closing date, or is that from the 45th day forward?
Yeah. So
when does that 180 days clock start?
It starts from your closing date. Okay. So after the 45th day, you have another 135 days to close.
I see. And which I assume, 135 days is fairly generous, or 180 days, like pretty much 6 months for that matter.
Yeah. The 45 days is usually the issue. The 180-day deadline is not usually an issue, although with the pandemic, it has become one because it's been difficult to close properties.
Right. Now, what other things, Michael, we should be aware of? Like, for example, we hear some cases where you cannot sort of 1031 directly into, let's say, a syndication of sorts, right? Because syndication typically, you're kind of combining forces and it's kind of a partnership and things like that. But I have I'm curious to know that how you can incorporate 1031 into a sort of a syndication framework as well.
Yeah, so this is going to be way simplistic, but it's the basic concept. So the issue you have is that the taxpayer that sells the relinquished property has to be the same taxpayer that buys the replacement property. They have to actually have ownership of the property. With the syndication deal, you're typically buying with other people in a limited liability company. So the buyer is the limited liability company, and that usually is taxed as a partnership. So the taxpayer there is the partnership. The person sold their property as an individual. So they cannot sell as an individual and buy in a partnership. Okay.
I see. Now, another related question. What if, like, typically I assume that, these are a lot of investors who are doing the 1031 as well. What if let's say, ABC Main Street LLC is the seller, and
Right.
now here you're trying to come into a syndication. How would that work? Are you saying that ABC Main Street LLC has to now kind of take some kind of an ownership, or give us a sense of how does that
Yes. So
plays
the
out?
typical way, whether it's an entity that's sold or an individual, the way we typically see a syndicated type, because it's not a true syndication transaction setup, is that 1031 investor would have to come in and buy an interest in the property as a tenant in common investor, often referred to as a TIC.
I see.
Okay. And so that means it will be two or more owners of the property. Instead of just the CDE LLC buying the property, it'll be the ABC LLC, which is the 1031 investor, and the CDE LLC,
Sure.
being the investors in the property. They will own it as tenants in common. The issue you have in a true syndication deal is that, typically we do a lot of stuff in syndicated entities that we cannot do in a TIC structure. So for instance, the syndicator, may be a person, maybe somebody who comes in and she went out and she found the property, right? And then she lined up the investors. She brought all the investors in.
Sure.
So she's putting sweat equity into this project. And then she's going to manage the property, and the other investors are going to be passive, right? So she's going to be the general partner. They're going to be the limited partners. She's going to run the show. She may be coming in with little or no equity, but she's going to want for her sweat equity, she's going to want equity beyond whatever investment she makes. So if she's putting 10% of the deal in, she may want at the end to have a 20% interest in the property. Okay. And those numbers I realize are kind of weird.
Sure.
A true entity, right? So in a TIC transaction, you must basically, if you put $100 into, $200 property, you have to get a 50% interest. Your interest has to reflect your investment. You have to be able to earn returns based on what your investment is. So if you put in half the proceeds, half the investment, then you have to earn half the profit. Okay.
Now, Michael, let me maybe perhaps try to clarify this. That so in a syndicated situation, you're saying that you have the actual entity, the LLC, that's basically purchasing the let's say a multifamily building here, right? And how do you bolt in the TIC or the tenant in common structure? Is that part of the general partnership, or is that part of the I should say the operating agreement of the LLC?
No.
Or is that the direct deeded interest within the multifamily itself?
Yeah, it's a direct deeded interest. So you'll have your syndicated entity where you'll have all your non-1031 investors, and you can do whatever you want with reason. Obviously, like you set up your typical syndicated structure there.
Sure.
Your 1031 investor is going to come in with their own entity, right? And be, let's say, a 50% or whatever it is. Maybe they're coming in with 25% of the equity. So they'll have a 25% interest in the property, and then the two entities together will own the property, and they will have a tenant in common agreement, which will provide for proportionate sharing of expenses, proportionate receipt of, and then you do that for a period of time. And then if you ever wanted to combine the two entities, you could probably do that a few years into the relationship and just make it one LLC. But at least initially, that 1031 investor needs to buy a property interest.
I see. So basically, so if I'm understanding this correctly, the syndicated entity and the 1031 entity or the person are kind of the tenants in common purchasing that, let's say the multifamily asset that we are discussing here. I see. Got it. Now, what are some of the complications in this? Because, I mean, it sounds like, it's a bit of an advanced topic, Michael, but for our listeners. But for example, let's say, a lot of times we'll have capital calls, or, let's say all the proceeds are changing based on, all different situations and things like that. So that whole structure that we are talking about here in the tenant in common, that the syndicated or rather the 1031 exchange party has to have a pro rata share into this. How does that work? Because are they getting diluted based on the capital calls and things like that? I mean, I'm just trying to think of those sort of intricacies that may occur.
Yeah, so they won't necessarily they don't have to be diluted. They can have a capital call. So they should. So if there's additional capital required, they should be contributing. along with the other entity, right? So the other entity will do their capital calls within the structure, however they want amongst the partners. But that 1031 investor, if they have the 25% interest, they're responsible for 25% of whatever additional capital is required.
I
You
see.
can provide that in your TIC agreement.
Mhm.
The bigger issue is the compensation for the syndicator, right? So you just want to handle that in your syndicated entity. The syndicator can still manage the property, so they can earn a management fee. And then, the other issue you have is that, some of the consents have to be unanimous in a TIC structure. Like to sell the property, you need unanimous consent.
That's what I was about to ask you, that
Yeah.
what about, sort of the voting rights and, who gets to say and things like that? Because, typically, as we know that in the general partnership and limited partnership, it's fairly streamlined, but it sounds like, tenants in common is like a equal ownership structure for
Right.
lack of a better word. How does those voting rights come into the play?
Yeah, so typically one way around that, because it's not so much the voting rights, because there'll probably be a minority interest in the TIC, but there are those things that need to be unanimous under. There's some guidance that's provided. It's a kind of a long story. It's not a safe harbor, but there's a review procedure for anybody who's bored at home. It's Rev Proc 2002-22, which kind of gives you a bunch of different things you should include in your TIC structure. And so you have some unanimous decisions that need to be made if you're going to sell the property, things like that. And so what you could do to kind of control that 1031 investor, you could make the syndicator the manager of that 1031 entity. They cannot be an owner, but they could be a manager. And so therefore they can exercise the voting rights, et cetera. So that's a little bit aggressive, and that's not universally accepted amongst tax professionals, but many say that could work to kind of give control of the syndicator over that entity.
Now, Michael, just stepping back a bit, like, let's say a family decides that, yes, it's great for us to, defer and invest this money and keep on, doing the 1031. And I know certain families who have sort of, used 1031 4 or 5 times, and they, in a rapid succession, they went from deal A to deal B to deal C and things like that, and they definitely availed that. But ultimately, if I were to maybe kind of step back and say this, is that you are at some point pretty much taking that conscious decision that this money is going to be deferred, sort of the taxes towards this are going to be deferred in perpetuity, meaning that you can take 500,000 out of your nest egg and keep on reinvesting it for the greater good later on. And meaning that it's a pure deferment strategy. It's not something that you can kind of withdraw and take buy a boat or something that we were talking about, right? So is that kind of how it plays out into this?
Yeah. So yes, it is, and you're absolutely right. So this is a tax deferral vehicle, not a tax elimination vehicle.
Right.
So that's, you're just kicking the can down the road. So the goal here, or the ultimate play, is we call it swap until you drop. Right, so you continue to do 1031 exchanges during the course of your lifetime, and then you drop dead. Right, hopefully after a good long life, you drop dead owning the property. Well, your estate under current tax law gets what's called a step up in cost basis, which basically makes the accumulated gain disappear, and your estate gets that property. If they sell it the next day, they will pay no capital gains taxes.
I see.
Okay.
Now, another related question into that, Michael, comes up is that who's keeping track of all this basis? Like, let's say if I'm going from property A to property B to property C, is there anything in the sort of the trail of documents that's saying that, okay, when you started, your basis was, let's say, 500,000, but now when you went to the new property, you were at 750K and things like that. How does that work?
Yeah, so you should have a good accountant, number one. And every time you do an exchange, you have to complete Form 8824, where you'll need to calculate the going forward basis of your replacement property. Okay, so there's that record. Now, of course, during your ownership, you're going to change your basis. You'll be making improvements to the property, which will increase your basis. You'll be depreciating it, which will be decreasing your basis. And that's all reflected on your tax return. And so your accountant should be tracking all of that because you're going to need it at the end of the day when you ultimately sell and cash out. So that's important. You want good record keeping, good, this is not something you necessarily want to do on TurboTax unless you're pretty proficient. You probably want a good accountant. I happen to work with TurboTax myself for my own return, but I'm not doing 1031 exchanges.
I hear you there. Now, another question into this, Michael, comes up is that we are using, like, let's say, loan or debt is already involved into all of this. How does that play into it? Is it something that, let's say, if you're selling a property for, $500K, your debt was $400K and sorts. So your basis is now $100K. Is that as simplistic as that, or what are some of the nuances?
Yeah, so that's not how it works at all, actually. So
okay, scratch that idea.
Yeah, so the way it works, and you're close, but essentially your debt has nothing to do with your capital gain. And people sometimes get confused. I've actually had accountants. I've done phone calls with accountants, and they've made that mistake, which is kind of scary. Essentially, if you think about it, because if that was the case, all you would need to do to eliminate your capital gain is get 100% financing, right? And your capital gain would disappear if somebody would give it to you. So your capital gain is calculated by taking your sales. Basically, you have to figure out what your cost basis is. Your cost basis is whatever you paid for the property, plus the cost of any improvements, less any depreciation you've taken during your ownership of the property. That gives you your cost basis. So if you bought it for $100,000, you made $50,000 of improvements, right? But you depreciated by $25,000. Your cost basis is $125,000.
I see.
If you sell that property for $200,000, your gain is $200,000 less $125,000. It's $75,000.
I see. So pretty much the net profit is what you're going after, and the debt probably doesn't play into all of that, basically.
Correct. You're paying off your debt, which means there's less cash available to buy a property. But it's also important to note that you're not just reinvesting your profit here. You also have to reinvest your basis. So if you sell that property for $200,000, you have to buy a property for $200,000 or more, less closing costs, if you want to fully defer your gain. You can go down in value, but you'll just pay tax on whatever that difference is. Right. And the general rule of thumb is to fully defer your gain, you want to buy property that's equal or greater in value to what you sold, and you want to spend all of your proceeds from the sale, which means that you'll probably have to take on the same or greater debt than you had on the other property.
Right. And to put it in that into context, taking that prior example, Michael, is that you bought a property for 100. Let's say you had an $80,000 loan, and your sort of your equity was 20,000. You made some improvements, and you for 25,000. Now you are at 125, but you sold it for 200. Right. So your net gain is 75. But what about the sort of the again, this is getting a little detailed here, but you invested, let's say, 20,000 as your equity, then you invested 25,000 as your sweat equity, or improvements and all that. Right. How does that play into it? Like, it seems that 75 is a sort of a net number that you see, but how do you capture that 20% that you contributed initially, and then also the 25,000 that you made into capital improvements?
Yeah, that's going to be your basis for your new property. So if you go and buy something for 200, you're still going to have that same basis, right? Now, if you went from 200 to 300, if you sold for 200 and went to 300, now you have that basis plus another $100,000 because you've gone up in value. Okay, that's how it works. You don't get to pull it out, though, because the way it's viewed, any money you take out, let's say you went from 200 to 180, at $20,000, you'd say, like, well, I paid $20,000 for the property. I'm just taking my cash out. I'm taking my investment out. That should be tax-free. That's not the way it's looked at. It's looked at your $20,000 always moves forward first. And then anything you take out is viewed as part of the profit. The way I describe it, a good way to look at this is you sell a property, you get 2 bags of money, right? One bag is your cost basis. That's what you invested in the property. And the other bag is your profit.
Right.
Okay. When you go buy the new property, the first bag of money that gets moved is your cost basis.
Right.
Okay. Then you move your profit bag. If anything's left, it's from your profit bag and you pay taxes on it.
I see. Got it. What now? We are just about coming on our time here, Michael. I appreciate all the details that you have shared. What are some of the restrictions or any limitations or prohibited transactions and things like that into all of this?
Yeah. So you do not want to do a 1031 exchange on a flip. Okay. So the property, the way it's described in Section 1031 is it only applies to property that's held for, quote, productive use in a trade or business or for investment. Okay. And 1031 also specifically excludes property held for resale. Okay. So if you are buying something, fixing it up.
Are you getting at like seasoning requirements?
Yes.
Is that kind of what you're getting at?
I am. It's seasoning, but it's also use, right? So, you know, we talk about seasoning because that's evident on the face of your tax return.
Right.
Excuse me 1 second. I apologize. I had my ringer up. So, you know, so you look at it and your basically the holding period is most evident on your tax return, but the property has to be held for investment rather than resale. Okay.
I see.
Meaning that typically you want to apply it to a rental property.
Sure.
So or, you know, a property that you're operating a business out of. If you're just buying it on, you know, in January, spending 6 months fixing it up and then flipping it to somebody else, that's not what 1031 is designed for.
I see.
Okay.
I see.
You know, typically we look at a holding period of, you know, 2 years or more conservatively, maybe as little as a year if you've rented it solidly for a year before you do a 1031 exchange.
I see. Any others, Michael?
Let's see, what else? You cannot buy a REIT in a 1031 exchange. Sometimes we get asked that you could buy something called a Delaware Statutory Trust, which kind of looks a little bit like a REIT, but a REIT is a stock transaction. It's a security, and so you cannot buy it in a 1031 exchange.
Sure.
You know, timeshares, right? So people are like, oh, I'm going to go buy a timeshare. Timeshares, there are some that are a deeded interest in property. But by and large, they're not in it. You don't get an actual deed, and so doesn't qualify. Also, most timeshares you're not going to have held for investment; they're for personal enjoyment. Okay,
right.
Which brings us to vacation homes. Vacation homes are another thing. If you have a vacation home that you're looking to do a 1031 exchange on, it has to be something that's been rented. And there's a safe harbor that says that in the 2 years prior to the sale, in each year the property should have been rented at least 14 days to a non-family member. Okay. And used no more than 14 days or 10% of the time that it's rented. Okay, so if you're just there, you know, using it and water skiing on the lake and, you know, and never renting it, do not do a 1031 exchange on it.
Got it. Awesome. Thank you. I appreciate all your insights, Michael. This sure is a loaded subject. And as you said, definitely a qualified intermediary like your firm and your expertise are definitely needed in all of this, setting it up right and getting it right. So I appreciate all your information today. Kindly share with our listeners, Michael, how, they can connect with you and learn more about your company.
Yeah, sure. So you can definitely find me on LinkedIn. I'm on LinkedIn quite a bit. I do post articles and I'm there. So you can look me up on LinkedIn. Best way to reach me typically is email. I check my email religiously. It's mbrady, like the bunch, Brady, mbrady at madison1031.com. That's also our website, madison1031.com. We have a bunch of information there, including the Madison 1031 Zone blog where I post articles. We have some new information coming out as well on there. So yeah, check that out. And, we also have a newsletter going out if you want to enroll and be part of our newsletter.
Awesome. Thank you for all your insights, and for listeners and viewers of the podcast, thank you for listening to it on all its entirety. If you are interested in working with us, we definitely have lots of deals on a monthly basis, it seems these days. And we also are hosting experts like Michael all the time on the podcast. So it's been a pleasure. Thanks a lot, Michael, for coming on.
Yes, thank you for having me.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.